Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 134, we're going to get more into a policy type of discussion looking at the future of estate taxes. Now, there's been a lot of hand-wringing over what might happen this year with a Senate that could be controlled by the Democrats, although with a slim margin based on the vice president. What tax law changes might be on the horizon? And as we're going to see, these have been looked at in a vacuum, but I think it's important to consider the loss of basis step-up under Code Section 1014. So we're going to kind of look at that holistically across the board with estate and income tax, and also look at some examples from current or previous tax laws and even other countries that might come into play when we look at estate tax policy in the future and what might be easiest to enact. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, the problem, based on numbers we'll run later, is that everybody is myopically focused on the estate tax exemption or the exclusion. You can call it either one colloquially or based on actual terminology, but effectively what it does is it exempts the first dollar portion of your estate, whatever that exclusion might be, from the estate tax, and the first portion of your lifetime taxable gifts from the gift tax as well. Now, if you just look at that exclusion in a vacuum, you tend to ignore a number of other components of estate tax that could be changed by Congress. One is the actual rate, which is currently 40%. Another is, as I mentioned, the step-up in basis. And the issue is that it currently applies regardless of whether estate tax is paid. So we're going to kind of touch on that later. We also look at the treatment of prior gifts. That's on the chopping block, potentially, with no set agenda or threat, but these are all things that have been floated. Certain lifetime transfers that have been blessed in the past could all of a sudden become subject to estate tax. Things like grantor trusts, abusive grantor retained annuity trusts or GRATs, and even family entities. Some of these have been attacked already, like family entities, and the standards upon which they're subject to transfer taxes could be expanded. Then finally, a number of states could be looking to curb their loss of revenue, especially from COVID, and state death taxes could become another consideration. I cite, for example, California, who was looking at that last year. I'm not sure what the outcome was, but I think that shows a trend towards the fact that in the past, a number of states had estate or death taxes at the state level, and they largely got rid of them throughout the 80s and 90s and some in the 2000s. But those could come back ultimately. So just looking at the exclusion ignores a lot of those issues. And ironically, I'm going to look at one issue here, really just the step up in basis, but I'm going to look at it in light of what the effective estate tax rate might be. Now, before I really get into that, it's important to note that the applicable exclusion has been the myopic focus, as I mentioned, because that started out being only $675,000 20 years ago at the start of 2001. And then the Bush administration started the ball rolling on the various tax cuts that has caused that exclusion to increase almost 20-fold in the last 2 decades, now to a record high of $11.7 million. So originally, the exclusion was really just a way to provide some financial and administrative relief to smaller estates or to the first portion of your estate, but ultimately, that exclusion amount and the concept of it has morphed into more of a political tool, which is used to gamble for advantages in more omnibus income tax types of changes and laws. And that's for good reason that it's such a front-of-mind issue and political tool, because it allows the wealthy to give away a significant chunk of their estates, up to $11.7 million per individual, free of gift and estate tax. So if you had a married couple, you could combine that and give away up to $23.4 million free of gift and estate tax. And even better, that amount increases based on inflation every year. So it was 11.58 million last year. It's now 11.7. It'll probably be closer to 11.9 or 12 next year. It's going to keep going up in larger and larger chunks every single year, especially if there's hyperinflation, which is a possibility given everything going on in the world. So the exclusion, if not changed by Congress, could skyrocket in the future. But part of the reason that the exclusion is so effective is not based on its dollar amount, but more because of the basis step-up. Now, starting out, this is the easiest change, if I were a member of Congress, that I would make to the tax laws if I were charged with finding easy ways to raise more revenue, especially because the discussion of the exclusion has been so polarized. So, the biggest loophole, I think, in the tax code is that the basis step-up applies to both taxed and non-taxed assets from an estate tax perspective, because what it does is it looks at everything that's within the gross estate, which is the estate tax base, and gives a step-up in basis for all those assets. And not only that, it includes the 11.7 million in assets that aren't subject to estate tax due to that exclusion amount. So on a macro level, what that step-up was designed to do is to avoid subjecting gains that accrue during the decedent's life to both income tax and estate tax. So this is a tool that was designed to avoid double taxation, but it eventually morphed into something where, with a high exclusion, it created zero taxation for gain that accrued during life. So what we're going to look at is that this also kind of, by operation, takes a bite out of the 40% estate tax rate, regardless of what the exclusion amount might be. So you can't truly state that the estate tax rate is a 40% rate as long as there's a basis step-up involved. So the step-up in basis could be an easy change, and it's something that Biden has proposed to get rid of. And that's not unprecedented either. Back in 2010, when the Bush tax cuts were set to sunset and expire, there was a proposed scheme which became elective in that year where the estate tax completely went away. And you had the option to replace that with a limited basis step-up, I think of $2.2 million, where instead of getting a full step-up in basis, you could only step up the basis of $2.2 million, and the rest had a carryover basis where the recipient ultimately paid income tax on the gain that accrued during a decedent's lifetime, but without reduction for estate tax either, since that went away. So essentially, the estate tax exclusion was replaced that year with a limited basis step-up exclusion. Now, what's the effective estate tax rate? This is something I've covered in a previous episode, but I thought it would be worth revisiting. Just quickly, if we had an asset worth 10 million and we assumed it had a basis of 3 million and gain of 7 million, that asset would be subject to estate tax at death. And ignoring the exclusion amount, if we assume that didn't exist, that entire 10 million would be subject to a 40% estate tax, which applies to both the basis, which is 30% of the value, and the gain, which is 70% of the value. But because the gain is eliminated by the step up in basis, you can't truly state that the effective tax rate is 40% of the value of the asset. Really what it is 40% minus the capital gain rate applied to the growth. So in this case, the numerical example is that you start with a 4 million estate tax, but essentially the step up in basis eliminates 1.75 million in capital gains that would have been paid had the decedent sold that asset during life. So that really means that there's an effective tax here, not of 40%, but instead of 22.5%. Now, this isn't a perfect example. It kind of ignores the progressive nature of tax brackets, but that shows that if the step up in basis is eliminated, what that essentially does is it increases the effective tax rate on the portion of the estate under the exclusion amount, really from 0% to 25%, and for the portion of the estate over the exclusion amount, it increases the effective tax rate from 40% minus the capital gain rate on the percent of the gain, up to 40% as a flat rate across the board, or even greater if Congress were to increase the estate tax. Now, there is a wild card out there as well, known as income in respect of a decedent. That's an item of, that's a class of asset where if it's owned at death, there's no step up in basis treatment. So we already have precedents for this, and What this does is it says that whoever receives that IRD steps into the shoes of the previous owner, the decedent in this case, and pays income tax as if they were that original owner. But there's a catch here. To avoid that double tax, since there's no step up in basis, there is a miscellaneous income tax deduction that recipients of IRD can take for the portion of estate tax that was attributable to that IRD asset. So the big question is whether a similar deduction might come into play for a beneficiary's recognized capital gain where estate tax is paid. So if they eliminate the step up in basis, they might have to look at enacting a deduction like this to avoid that double tax issue. And another option is similar to Canada. There could be a further step where not only is the basis eliminated, but there is a deemed disposition tax where instead of an estate tax, the assets owned by a decedent are deemed to be sold for their fair market value at death. Now, this is a system that exists in Canada, and there's a deemed sale of assets in Canada when an individual owner dies, or in the case of a trust, every 21 years. So the bridge to this, as I mentioned earlier, is that elimination of the estate tax in 2010 and the replacement with a form of a limited step up in basis. And there is no forced sale of the asset under that, but it assumes that at some point the beneficiary is going to liquidate that asset and trigger income tax recognition on the gain. Now, another example that got us closer to this is the Secure Act, which was passed at the end of 2019. With that, it forces tax recognition of an IRA, not immediately, but now within 10 years of death if there's an individual beneficiary who's not eligible for the lifetime stretch. And if there's not an individual beneficiary, there's a 5-year forced tax recognition under an IRA or tax-deferred asset on the retirement planning side. So, what's the big picture here? There's a few key points I want to drive home. One, the loss of the step up in basis might be a bigger deal than the reduction of the estate tax exclusion. So with the step up, as long as it's there, the effective estate tax rate is actually less than 40%, at least for capital assets. And without a step up, the gain component could be double taxed, both at the estate tax rate and the combined federal and state income tax rate for those capital assets or assets that trigger gain on sale. So if that step up is ultimately eliminated, the question is, might there be an income tax deduction for the estate tax paid that prevents double tax on that gain? And if not, might we run into a situation where maybe IRD, which does get that deduction, becomes a more favorable legacy asset due to carrying a lower tax rate? And ultimately, down the road, might we see the estate tax replaced with the limited basis step up like we saw in 2010, or maybe even a deemed disposition tax? So, as you're doing planning, and as you're looking to the future, nobody can predict the future, but it's important to note that just looking at the estate tax exclusion doesn't capture the big picture. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.